Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course enough to make it actionable, understandable, and clear. What a week. And of course, what a show. Boy, it's cold out there. Whew. Keep the furnace coming. Be very wary of using a fireplace to create heat in your home. That's for another podcast, another time, but Google it. We're going to look at three important topics. The first one has been an incredible advancement in financial intermediation over the years. We're going to look at Vanguard's announcement of two new exchange-traded funds to help meet your liquidity needs. I'll explain why this is a big deal and something I've been looking for a while. Next up, we're going to step into the corner. It's a wonderful day in the neighborhood. Won't you be mine? Could you be mine? Won't you be my neighbor? Coming to Robert's Corner, we look at individual stock selection dreams and the deceptions that we can bring upon ourselves. We're going to be looking in particular at the stock Carvana. If you're a Dude Perfect fan, you notice some of the latest videos were sponsored by Carvana. We're going to talk about the stock. And then we're going to describe what happens when you leave a money manager. What is it that you have to do? Money managers are active and they're picking various stocks for you, but they're letting you hold the stocks in your account. What are you supposed to do? So we will look at each of these three. So at the top, maybe we should start off with how to spell financial. I have a guest in the room. Guest, would you come over here to the microphone, please? We're doing one mic. How do you spell financial? It's a word.
Financial.
That's very exciting because this was on your spelling test, and you felt like you had an unfair advantage. Why was that?
Because my dad is a financial advisor.
And the benefits accrue day after day. You know, they say, Lucy, that no financial advisor is without honor except in his hometown and amongst his own family, but not so with Lucy Hunt. You hold the profession in high regard, don't you?
Yes.
So much so that you know how to spell financial. I love it. I love it. Well, we're starting off at the top, Lucy, with short-term liquidity needs. Vanguard came out with two new exchange-traded funds. So these two ETFs, I think they create freedom for the investor. So I just want to explain why this matters. So if you are a Vanguard brokerage client, meaning not just that you buy the Vanguard products at Schwab or Fidelity or E-Trade or anywhere else, you literally house your money at the Vanguard brokerage account. Your default cash account is the Vanguard Money Market Fund, which today is about 4.25, 4.3%. Really good. And that's the default cash placement, meaning if I get a dividend or I sell a security, it automatically sweeps it into this account and you get that excellent yield without any extra effort for yourself. It is not the case at Fidelity. It is not the case at Charles Schwab. It is not the case most places. Why is that? I've mentioned this previously in the podcast. Vanguard is a mutual fund company owned by the shareholders. It's effectively owned by the funds, which are owned by the shareholders. The fund owners, not the shareholders, excuse me. Whereas Fidelity, owned by the Johnson family, and Charles Schwab, owned by the shareholders, they have to be looking for nickels under every couch. One of the nickels they look for under the couch is the spread between the rate they pay you in deposits and the lending they do. So Schwab, if you just sell a security and the money sits in the account, it earns very little. Nominal amount of interest, close to nothing. Fidelity, same deal. Vanguard, we're so glad for it. But what happens if you're not at Vanguard? What if you're not at Vanguard? What if you're at Schwab or Fidelity or any other brokerage account and you can't default in the Vanguard money market? And you're in this sort of walled garden where they're forcing you, I'll take Schwab as an example, to buy their higher priced money market funds. In comes this beautiful announcement by Vanguard about these two new ETFs that are effectively, one is VGUS, that's ticker symbol, Vanguard Ultra Short Treasury ETF. The second is Vanguard 0 to 3 month Treasury Bill ETFs, ticker VBIL. These are two fixed income ETFs. The expense ratio is 0.07%. Because you're a listener to this podcast, you know that's really good. And when we compare that to, say, the expense ratio for the Schwab Value Advantage Money Market Fund, which is 0.34%, you realize, wow, that's a big old difference, and almost a factor of 5. So you now, and at Schwab, which there are no fees for trading, or at Fidelity, again, typically no fees on commission, although Fidelity was playing with that. You can now jump this walled garden and invest in these securities and earn incredible yields. So the 3-month T-bill today is 4.324%. So that's about what you'll get with ticker symbol VBIL, and you're able to access this from any brokerage account in the world. Now, in the United States, forgive me, there are different product offerings around the world, which can be confusing. In the United States, you can access this. So this just, it keeps getting better to be an investor, and don't let anyone tell you otherwise. Oftentimes, the Eeyores, which you remember that donkey and that Christopher Robin had in Winnie the Pooh, he was always negative. Oh, it's a bad time. Everything's against us. It's a bad time to invest. I've never seen a better menu for investors than I'd see today in 2025. I've never seen it so good. Now, the difficulty, of course, is what item on the menu do you pick? You remember the Denny's menus with the pictures? I used to like that. You just point to it. It is way more difficult in the financial product space because of the multitudinal complexity, oftentimes I fear, done intentionally by the industry that keeps you in the dark. But you're listening to this podcast, so you're getting some clarity. So take heart, investor. We now have these 2 ETFs, and there were some other ones that were pretty good. But now that Vanguard is in the game on these short-term liquidity offerings, this is really going to open the door to where increasingly it's not as big a deal where you house your money. I still think Vanguard's the best. I think they all have pros and cons. But the fact that now you have this access at Schwab or Fidelity is excellent. Excellent. And cash management can be such a burden for people. We have so many kind of accounts to just create some sort of a cascade of cash management. I confess I probably have more accounts than I should have, but ultimately I convince myself I need them. When I'm working with clients, I'm almost always looking for ways I can reduce the number of accounts they have. I see this as a potential solution for many people who may have to use an online bank account with a high yield online bank account like Marcus or Capital One 360. There are a whole host of others that get you a fine yield, but you have to open up a new account. This is a way, hey, if you've got a brokerage account, you can invest in these ETFs. Maybe that's a solution. Maybe not. It can be clunky. It takes 2 days to get the money, maybe longer. But fight on, pray on. We are gaining ground, investor. It's a great time to be a consumer. Next up, we're going to look at the dangers of convincing ourselves we're good at individual security selection, and I'm going to let you into the corner on a stock that I've been thinking about. So I don't expect any of you watch the Dude Perfect show, but they recently did an episode, my children like watching it, on Carvana, which sells used cars and has this kind of, it's almost a vending machine of cars. So it shows, you walk into this giant tower type structure, and what happened with this stock was it has been on an incredible ride. And when I say incredible, I mean breathtakingly incredible. So this is the danger. So Carvana, today it was down 12%. So they did something that spooked people. But Carvana in August of 2021, it, believe it or else, traded at $360 a share. $360 a share. Well, believe it or else, top to bottom, it went down 97%, down to 2022. So in about a year's time, you lost almost all of your investment. However, had you invested at the lows, you would have more than 70 or about gone 70x on your money. Again, this is an individual stock. It's a big old stock, almost $30 billion market cap. That's the number of shares multiplied by the price of the share. It gives effectively, they call this, it's the financial size of the company. What's the liquidation value of the shares? 30 billion is a big company. So you would have, if you invest in the lows from that big drop down, if you had seen the value, if you had uncovered the value, you would have gone 70x on your money. Meaning, just think of if you put in $1 million, you'd have $70 million. If you put in $1,000, you'd have $70,000. That's a breathtaking return on one security. And I catch this in the news, and I find myself doing this. Carvana, yeah, I know that company. It's a used car company. I go back. I start to Monday morning quarterback to the positive. Oh, I could have seen that. Yeah, of course the market overreacted. Certainly it did. I should have invested at the lows, and wouldn't have that have just saved me a whole host of time waiting on these fuddy-duddy index funds to decade by decade increase in value. I could have 70x'd in about a year and a half. Can you even imagine? That's a lifetime's worth of investment returns if you're lucky and you pull it off in 18 months. Do you ever feel that way, investor? This is where I need call in. Call in 1-800-777-2737. We're taking your calls here. We'd love to hear from you. Investor, do you ever have that? Do you ever have that historic mindset where you think to yourself, if I could just gone back, I would have done that. Here's the danger. That's going to convince you can do it on a go-forward basis. My encouragement to you, before you start going down this road of individual security selection and convincing yourself, you can spot the bottoms and spot the tops, because you got to be right twice, okay? Right? I mentioned, hey, if you had invested at the lows in early 23, late 22 with Carvana, and then sold at the highs, which not today, down 12% today, which is about 281 February of 2025, early February. You have to be right twice. I would encourage you, be a paper trader, meaning open up a Google Sheet or Excel doc. And if you think a stock is undervalued or overvalued, start placing your trades, mental trades, not too many. This is a great way for you to double check yourself, because I think what we do is we play games with our mind and say, oh no, I would have picked that. I did pick that. Moreover, what else you can do is look at the SPIVA report. I mentioned this a lot, I know, but it shows, it's the referee, if you will, that Standard & Poor's puts out, showing the difference between active and passive managers. 95% of active managers fail to beat their indice over a 15-year period. So where all these active managers, where are they? Why aren't they getting great returns with Carvana? Why aren't the other 80-hour weeks, armies of analysts? Why can I in my PJs with one article of the Wall Street Journal beat them? I don't think so. So be willing to take captive those thoughts. Make them obedient to the truth in finance. And then you can always remember, he who gathers little by little will prosper, but wealth gained hastily will dwindle. Do you really want it to dwindle? Well, that's what you're hoping for with a 70x return in 18 months. Goodness me. This is more confessional, though. I still think, what if I done it? What if I done it? We got to fight against it. And in closing, this comes up a lot in my work, and I wanted to just shine some light on it. So if you're with a money manager that picks stocks for you, but not at the fund level, that they actually will buy the individual stocks for you and actively manage your fund, but it's in a brokerage account, it's in your name, they just have discretion, meaning they are able to place trades on your behalf, but you hold the stocks. And the moment you sever that managerial relationship, those stocks are yours and are in your account. What do you do if you've seen the light? You've elected to go with indexing. What are you supposed to do? How are you supposed to move forward? Well, the first thing I advise folks look at is, what sort of tax consequence would there be to selling the stocks? If all your stocks are below the original cost basis, meaning they would sell at a loss, short-term or long-term loss, I tell folks, sell them all. Sell them all tomorrow. Buy an index fund. You can buy VT, which is Victor Tango ETF, Vanguard's total world stock market, about 65% now, North America, 35% rest of the world. You're done. It's rarely that simple, though. Typically, there's a smattering, a mix of some securities that are trading below their cost basis, others that are trading far above their cost basis. So I will typically recommend, hey, sell all the ones that trade below the cost basis, capture the capital loss carry forward. That's what they call it. It's where you get to capture that long-term or short-term capital loss. Those last forever for your lifetime. So you get to kind of stow those away. And then I tell folks, if they want, I cast the vision, depending on the juice was worth the squeeze on the tax hit. If there's large gain, I say just keep the stocks you have. Let's say they have 20 stocks. I will say just keep them all. You now have your own little index fund. Now there are risks with this because it's probable you will either lag or exceed the index on any given year, because your previous money manager, I bet they own stocks all over the place. What you've done is you've removed the fee wrapper, whatever that money manager was charging you, 1% or whatever, that's gone now. You've captured your losses, and now you just own these stocks. And instead of taking a big old tax hit, capital gain, you now own these stocks, and you just own them. Now the question may be asked, and this comes up quite a bit, but who's watching my stocks? Don't I need someone to watch my stocks, manage my stocks, ensure I'm in the right stocks, or ensure, hey, what if the CEO of company ABC goes absolutely mad and that stock just tanks? I only have 20 stocks. I really can't afford for that to happen. Here's the deal. Those stocks have never been watched. Even with your active manager, there is no such thing as watching stocks. Now, I'm an efficient market theorist, meaning I believe that all available information is priced into a stock. So there is no, I saw this coming, I'm going to get you out of the security. Ooh, this might happen. I'm going to reduce our position size here. None of that was to your benefit. All of that was presumptive that it would help you. It wasn't material to your return. So I'm quite all right just letting the stocks live. This is the Montessori approach to security investment. You're simply letting the stocks go on their own. You don't need to intermediate, right? Maria Montessori, child-directed learning. We are letting the stocks be on their own, do their own thing without intervention from you or from me, and they'll be just fine without us. Now, there are exceptions where you have such a concentrated position, such a volatile stock that we ultimately just sell the security, take the tax hit, because the diversification benefits are so great that we are going to just take the tax hit. But usually what these money managers, they don't do that. They usually spread you out. It's basically like a mutual fund. And so if you are at a money manager and you are worried and you think, oh, gee whiz, I think I want to do this on my own, but what do I do? How will I do it? Don't you worry one bit. You just focus on what you can, and you let those stocks fend for themselves. And what can you focus on? I thought you'd never ask. Keeping those costs low, that investing simple, and that time horizon long, because that's what's going to give you the best shot on your investing journey. Until next time.